Today we're going to be talking about basic accounting transactions and the double entry accounting system. If you take a look over here at the board, you will notice that we have different types of accounts in accounting. We have assets, which are things that a business owns, liabilities, which are monies that a business owes, often indicated by the word payable. We have equity, which is the interest or position you have in a business. We have revenues, which are dollars that are generated from selling a product or a service. And then expenses, which are costs incurred to do business. These are the 5 different types of accounts that we will be working with in applied accounting. Now, when we talk about accounting, we use what's called double entry accounting. Double entry accounting means that we have to have at least 2 accounts affected by a business transaction. There is going to be something increased and something decreased. It could be 2 of the same items here of the 5 different account types, or it could be 2 different ones. But there always will be at least 2 items affected by a business transaction. What we have to determine is which one out of these 5 will be increased and which one will be decreased. So what we're going to talk about is the normal balance of these different types of accounts. And you will see this in your textbook as well as the PowerPoint that accompanies this in the introduction called Accounting Basics. It is a content item in your course. So what I'm going to do right now is I'm going to show you that for each one of these account types, they have a normal balance. Now, when I talk about a normal balance, I'm talking about either one side is going to be increased or one side is going to be decreased. I'm not saying debit or credit. I'm simply saying increase or decrease at this point. You will definitely want to memorize the normal account balances of each of these 5 account types throughout the semester. So again, we'll start with assets. We're going to put a plus either on the left side or the right side of this table to show the normal balance. So assets, again, are items that a business owns. Assets have a normal debit balance. So I'm going to put a plus here on the left side. So anytime that I want to increase with the double entry accounting system, I will place a positive on the left side. Liabilities are those amounts that are owed to other businesses or people, oftentimes indicated by the word payable. The normal balance of liabilities is a credit. So we will put a plus sign on the right side to show the normal balance. Equity indicates the position or interest that you have in your company. And all equity accounts have a normal credit balance. So again, we will put the plus over here on the right side. And again, this is something that you should memorize in the first few weeks of the course. Now, revenue is money that is generated by your business for products or services that you sell. Revenues, no matter what they are called, have a normal credit balance. So again, we will put a plus on the right-hand side. And finally, expense are those monies that you incur as costs to do business. Balance. So we will place these on the left side. So again, we just went through the 5 account types, and we talked about what side is affected, left or right. It's indicated by a debit on the left side, a credit on the right side. The abbreviations for these that you will see in the text are DR for debit and CR for credit. The next thing that we need to do at this point is to find out how we decrease these account types. So we're going to look at that as well as how we increase them. Actually, what we'll do first is we'll talk about how they increase. If the normal balance is on the left side for assets and expenses, then the normal increase would also be on the left side. If we're looking at increasing our liabilities, our equities, and our revenues to show that they're growing, then we will do, again, a plus on the right side. So you can just remember that to increase any of these 5 account types, you would do so under the normal balance side. Now I'm going to use a blue marker to indicate to you how we would show a decrease. So for example, if we have some assets that we sell, to show that we are getting rid of them, we would do the opposite of the normal balance or the increase side, so we would credit them on the right-hand side. So we're decreasing. Liabilities, those amounts that are owed to other businesses, when we pay them, we will show that we are decreasing them with a minus sign to the left-hand side. Now, equity, our interest or our position in the business, when we decrease that, let's say, for example, we take money out of our business for personal use, we would show that as a negative on the debit side because it has a normal credit balance, and we increase it with the credit side. Revenue is the same way. Revenue, if we're going to show that people bring back some items and our revenue has dropped, we will show that with a decrease on the debit side. And finally, expenses, to show that we are decreasing expenses rather than increasing them, we will do the opposite like we've done on all the other 4 account types, and we will credit the expense account. This again is double entry accounting. I encourage you to memorize this table because this table is the basic foundation for all transactions in accounting. What we're going to do in the next few minutes is we're going to take some sample business transactions. We're going to look at the accounts that would be affected using these 5 different types, and we're actually going to record them to assist you in the learning process. If we take a look over here, when we have transactions in business, there are 4 steps that we should take to analyze them to determine if we are entering them correctly into our manual accounting system or our computerized system. The first step is to identify which accounts we are going to use. At this point, we are going to look at the chart of accounts. Now, the chart of accounts, if you look here on the screen, shows that for each different type of account, we have one of the 5 types. Now, for cash, cash is an asset, and that has a normal debit balance. So does accounts receivable, supplies, vehicle, and computer. Those are all assets. They have a normal debit balance, and we increase them with a debit. Each one of these accounts is labeled with an account number that is identified. It's the unique number that is assigned to them in your business. If you notice in the 2000s, we have our liabilities, accounts payable and notes payable. Oftentimes, the word payable indicates a liability, so you will see that word on many of your liability type accounts. You'll notice in the 3000s that we have 2 equity accounts. For this particular example, we're going to use Kyle Anderson. He is a sole proprietor. And we have an account called Kyle Anderson Equity. And we also have one called Kyle Anderson Drawing. We use this account, drawing, when we take money out of our business for personal use. The 4000s are indicated by income, and we have 1 income account in this example, and it's sales. Then in the 5000s, we have our last category, which is the expense type. And we usually list them starting with 5,000, going through to 5,300, etc. It depends upon the number of expense accounts that you have in your business. This is one example of account numbering. But I wanted to show you that for this particular business that Kyle Anderson owns, we are going to use this chart of accounts to determine, first and foremost, which accounts to use, which account type, and to determine if the account balances are increasing or decreasing according to our chart here of the account types. Then we will review finally, to make sure that we've done the transaction correctly, the normal balance table. So again, we're looking at entering basic accounting transactions using this table. At this point, we are going to go ahead and we are going to actually do the transactions that are listed here. We're going to again start with January of the current year, and we're going to assume that Kyle Anderson is going to set up this business on January 1st. So what I'm going to do is I'm going to read through the transaction, and again we are on January 1, and we are going to use the chart of accounts that is listed here, and we're going to use that to answer these transactions. So we're going to start with January 1. Kyle Anderson transferred $25,000 of cash into a business bank account to be used for business purposes only. So again, we have to ask ourselves, which accounts are we going to use from the four-step transaction analysis? And if we look at that, we're going to increase and use cash, and also we're going to use and increase Kyle Anderson equity. So what I'm going to do at this point is I'm going to create these transactions on the board as we go through them and show you how we're going to use the four-step transaction analysis to determine how to record these. So again, January 1 is our date. And over here, I'm going to put debit and credit. And again, the abbreviation is DR for debit and CR for credit. So on January 1, we have to ask ourselves, which accounts are we going to use? We are going to use the cash account because we are increasing that, and we are going to use the equity account because we are also increasing our position or our interest in the business because we are putting $25,000 into it. So, are the account balances increasing or decreasing? Assets are increasing with the cash, and our owner's equity is also increasing. So, record that. We will debit cash for $25,000. And we will credit Kyle Anderson equity for $25,000. Again, my debits on the left side must equal my credits on the right side. If we go back here to the four-step transaction analysis, we identified which accounts to use, the account type, which are asset and equity. Both of them are increasing, so we debited assets and we credited equity. Moving on to the second transaction, on January 1, Kyle also signed a lease agreement and he paid $1,000 for rent. So again, we have to ask ourselves, what accounts are we going to use? We are going to use an expense account, and we're also going to use an asset account. Now, step 3, are the account balances increasing or decreasing? Our expense account will increase because we are incurring rent expense of $1,000. So we will be debiting the rent expense account. We are taking cash out of our business to pay for this rent. So to show that we're decreasing that, we will credit cash. So again, January 1, We will debit rent expense, and we will credit cash. Again, an increase for the rent at $1,000 with a debit, and a decrease of cash with a credit. Debits equal credits. Moving right along to January 2nd, Kyle paid $3,000 cash for supplies needed in his business. Again, we have to ask ourselves, what accounts are being affected? We go over here to the account type, and if we are purchasing supplies, we are increasing supplies because those are items we own. But at the same time, we're going to pay cash for them, so we're going to decrease an asset. Oftentimes, this will be the case where you will decrease an account type and increase the same account type. As long as our debits equal our credits, we're fine. So what accounts are we going to use from our chart of accounts? We will be using supplies, which is account number 1200, and we will be using cash, which is account 1000. So, January 2nd, we will be increasing our supplies with a debit, and we will be decreasing cash with a credit. They are both asset type accounts, but we can have one transaction affect the same type. So, asset would be increased of supplies. We are also paying cash for them, so we will decrease our cash, which is an asset, by crediting it. Debits equal credits. Transaction on January 3rd, Kyle purchases a Ford truck for his business for $20,000. He paid $5,000 cash and is borrowing the rest from Wells Fargo. This is a very common transaction. This transaction is actually going to involve more than two accounts. Remember that we always have to have at least two accounts that are affected, and on this particular one, we're going to have three. So we go here to the four-step transaction analysis. What accounts are we going to use? Well, we're going to increase from your chart of accounts the vehicles account, which is an asset. We're also going to be decreasing our assets because of the $5,000 of cash that we are going to pay up front. But now we're going to use the liability account type because we are going to owe Wells Fargo the difference between what we pay and what we owe. So we're going to have an increase of a liability of $15,000. And we're going to use what's called notes payable. Notes payable is an account that we use if we have a liability that's going to take longer than a year to pay off. If it was less than a year, we would use accounts payable. So again, January 3rd, we're going to increase our vehicle account, which is an asset, by $20,000. That's the amount of the Ford truck. But we're also going to decrease cash because we paid out $5,000. So the difference will go into notes payable. And that difference is $20,000 minus what we paid in cash. So that would be $15,000. Our next transaction occurs on January 5th. Kyle completes his first sale and sends a bill, which is oftentimes in accounting called an invoice, to his customer for $1,500. So we have to look at the four-step transaction analysis. And identify which accounts to use. So we actually got our first sale completed. So revenue would be affected. And also, it doesn't say that we're getting the money yet. We just send the bill or the invoice. So we would affect an asset account called accounts receivable, which if you look at your chart of accounts is account number 1100. Accounts receivable is used as an asset account because we've just sent the bill. It doesn't mean that we have been paid for the bill yet. So we will use an asset account that will be affected as well as a revenue account. So January 5th, to show that we are getting money at a later date, we will debit or increase accounts receivable, which is an asset. And that amount, again, is $1,500. And we will increase our sales with a credit for $1,500. Again, the reason that we are not increasing cash is because accounts receivable indicates I've sent the customer the bill, but the customer hasn't paid for it yet. I'm hoping to get that soon in the mail. When I do, then I will take it out of accounts receivable and put it into cash. Moving right along to January 8th, Kyle receives a bill for his office being cleaned for $100. It tells us in the transaction to use the maintenance expense account, which is account number 5100, and that the bill will be paid at a later date. So we're not going to use the cash account to pay for this. We are going to use accounts payable, which indicates a liability. So again, which accounts to use? We will use the expense account, maintenance expense. That will increase. And we will use a liability account because we're not going to pay for this until a later date. To show that accounts payable is increasing, we will credit that account. So again, maintenance expense will be debited for $100, and accounts payable, which is a liability, will be credited to show that that will be increased. Again, reviewing our four-step transaction analysis, we identified maintenance expense and accounts payable as the accounts. Maintenance expense is an expense type, and accounts payable is a liability. Are the account balances increasing or decreasing? The expense account is increasing. The liability account is increasing. But we do them on different sides. On January 15th, Kyle received $1,500 from a customer for services that were completed on the 5th. If you look at your screen, you'll notice that the January 5 transaction is at the top, and this is where we sent the bill. Well, 10 days later, we're getting paid, which is what every business owner likes to see. So we have to ask ourselves, what accounts are going to be affected? What accounts to use? So if we look at our account balance table, we are going to show that cash will be increased because we're getting the $1,500. So we'll be increasing assets, and we will also be decreasing accounts receivable, which is an asset. Now, accounts receivable means we're going to receive the money at a later point. Well, it's January 15th. We're receiving it 10 days after we billed it out. So we will record this as a debit to cash for $1,500, and we will credit accounts receivable for $1,500. So we're taking it out of one asset account and putting it into another. Do our debits still equal our credits? Yes, they do. So assets are increasing in the form of cash, but they're also decreasing with accounts receivable. Moving on to the 18th, Kyle paid $100 for an invoice received on January 8th. Well, if we look back to January 8th, that was for cleaning the office for $100. If you remember, we did not credit cash, we credited accounts payable. Well, now we're actually going to pay that 10 days later. So again, which accounts do we use? We would use accounts payable to show that that's decreasing, and we would also show cash is being used as well. So how are we going to record that? To show that a liability is decreasing, we will debit it. To show that cash is decreasing, we will credit it. So we're using liabilities for accounts payable, and we're using cash for assets. So again, January 18th, we will debit accounts payable to take that $100 out of there and show that we are paying it. So we decrease with a debit. And then we would show that we are taking money out of cash to pay for it, which is an asset, and it's being decreased by $100. Again, my debits equal my credits. I have reduced my liability, okay, with a debit, and I have also reduced my cash, but with a credit. Moving right along to January 19th, Kyle received $3,000 of cash upon completing a job. Again, we have to ask ourselves, which accounts are we going to use, and what account types are they? So if we receive $3,000 upon completion of a job, we're going to increase our cash, and we're also going to increase our sales or our revenue. So if we look at our chart of accounts, we use cash, which is $1,000, and we will use account 4,000, which is sales. So again, debit cash for $3,000 and credit sales for $3,000. So the normal balance, to review that, what we're doing is we're increasing our asset, and we're also increasing our revenue, but we do it with different sides of the table. We increase one with a debit, we increase the other with a credit. On the 25th, Kyle received a $500 invoice from the local newspaper for advertising, but we aren't going to pay this until next month, until February. So again, we're going to use accounts payable. To indicate it's a liability, we'll pay for it in February. So, which accounts are we going to use? If we get a bill from the local newspaper, we're going to use an expense account. And the expense account we will use from your chart of accounts is account number 5,000, advertising expense. That will be increased. Now, to show that we're going to pay for it in February, we're not going to take it out of cash. We're going to take it out of our liability account called accounts payable, which will be increased with a credit. So to record that, we will debit advertising expense, which has a normal debit balance, and to increase it, we will do that as well, for $500. And then we will credit accounts payable because we're not going to pay it until February for $500. So again, if we review the normal balance table, we increase our expenses and we also increased our liabilities. January 29, Kyle takes $2,000 out of his business for personal use. And many times business owners will do this. They might do this for charities, for fundraisers, or for maybe taking a client out to supper, some type of expense like that. And so to show that we are going to reduce our by this, we will use an account called Kyle and Drawing. So if we look here at the normal balance table, which accounts will we use? We will be using an equity account called Drawing, and we will be debiting that to show that we're increasing that account. And then we will be crediting cash because we're taking that $2,000 out right away. So to record that, again, it's very important to put the exact date down for the transaction so that if you have an error or a question, you can go back and search through your accounting records by the date. So we will put Kyle Anderson, drawing. Okay, and that will be for $2,000. And we will be crediting cash for $2,000. Again, if we go back and we review our normal balance table, our equity account will be actually reduced, but the drawing account has a normal debit balance, but it will be taken out of equity, and we will credit cash for $2,000 to show that we are decreasing because we took that $2,000 out right away. On January 30th, Kyle purchases a $1,000 computer with cash for the business. So at this point, we have to ask ourselves what accounts are going to be affected. We're purchasing an asset, so that would be increased, but we're also paying cash for the computer, which will decrease an asset. So again, we're using the same account type for both accounts that are affected. One will be increased, one will be decreased. So January 30th, the account that we will use from our chart of accounts to show that computer purchase is account number 1400. So we'll debit computer for $1,000, and we paid cash for it, so we will credit that for $1,000. Again, do my debits equal my credits? Yes, they do. I increased an asset account with a debit, the computer, but I also took money out, $1,000 to pay for it, so I decreased cash. Finally, at the bottom, January 31st, Kyle determines that he used $1,300 of supplies during the month. We have to do a little bit of figuring on this because on January 2nd, we purchased supplies of $3,000. So if we look at the supplies account from this standpoint, this is a basic T account, and a T account is used to analyze one particular account in your business. Again, we're going to have the left side and the right side. So when we purchase supplies back on the 2nd, we increase them because they're an asset. We own them. We purchased $3,000 worth. So that was our balance at that point. Well, now on the 31st, we have used up $1,300 of supplies during the month. So what we have to do is we have to show that we've used this so that our ending balance is at $1,700. So all I did is I subtracted what we've used up from what we purchased, so my continuing balance then would be $1,700. How am I going to show that? Again, I'm going to go back to my transaction analysis. The accounts that will be affected are an expense account, which will be increased to show that I've used $1,300. But then also, I have to reduce my asset account by that amount, which is supplies. So I'll increase my expenses, decrease my assets. So again, we always put the debit amount first that you've noticed throughout these transactions, followed by the credit. So my ending balance, what I have left of supplies, is $1,700. I simply subtract the decrease, the credit, from the debit. Again, I have one expense account increasing and one asset account, supplies, decreasing. You've probably gathered from these transactions today that terminology is very important. The chart of accounts lists all the accounts that your business has. And it's very important that you get familiar with the names of those accounts and the numbering, and also to apply those accounts to the normal balance table. Now, one of the accounts that we worked with on a couple transactions, and I told you that that is a liability account. And we show an increase with a credit. We show a decrease with the opposite, with debit. We also worked with accounts receivable. Accounts receivable is an asset account, which means we have money that we expect to get from our customers. We just haven't received it yet. We use that instead of cash. We don't actually use the cash account until that money comes into us and it is in the palm of our hand. So it's very important that you distinguish the difference between these two. Don't get them confused. Again, the word payable often indicates a liability. The word receivable indicates an asset. One has a normal credit balance, so we increase it with a credit. One has a normal balance, which we would increase it with a debit. Okay? So make sure that you understand the distinction between those two terms. Now, if we were to look at the cash account at this point, there would be several transactions that would be included in it. And what I'm going to do is I'm going to take all the transactions that we've worked today and I'm going to show you what the cash balance would be after these transactions in the month of January. Now, if you were doing this with manual accounting, this would be the procedure you would use. However, when you use computerized accounting, like QuickBooks, which you're going to be using, it will automatically transfer these numbers into the cash account. That's called posting. The computers do it automatically, but to ensure that you understand that process, I'm going to show it to you manually before we close today. So, if we look at the cash account specifically by itself, in what we call a T account, I'll just put the name up here, cash, and you can do this for any account in your accounting business if you want to focus in on just the account. Again, I will put debit here, the DR, and the CR for credit. And I'm going to put down the transactions that we had. And I'm going to use the date over here, and I'm just going to put January 1st because that's when we put $25,000 worth of cash into our business to start it up. So we did that with the debit. Then, on the 1st, we took $1,000 out because we paid for rent. So we credited for $1,000. Then we purchased supplies on the 2nd of $3,000. Again, if you look back at your transactions, you will find these. And then on the 3rd, we had a transaction. If I go back to my transactions here, we purchased a truck, that Ford truck, and we paid $5,000 for that. And we financed the rest through Wells Fargo. On the 15th, we brought in money from a customer who paid a bill. On the 18th, we paid our cleaning bill for $100. On the 19th, we received $3,000 for a job that we did. We actually got it from the customer. On the 29th, we took money out of our business for personal use, so we subtracted $2,000. And then finally on the 30th, we purchased a computer with cash. So we took $3,000 $1,000 out for that computer. What I would do at this point is I would add the debit side by itself, and that comes up to $29,500. And then I would add up all of my credits, the money that went out of my business. And that amount is $12,100. To find out what the balance is of my cash account as of January 31st for this first month of business, I would subtract my credits from my debits. Because assets have a normal debit balance, it's going to be on the positive side, which is great. So 29.5 minus 12.1. My balance should be $17,400. Now, you've probably heard the comment that cash is king. Cash really is king because that determines your inflow and outflow for a business. Now, this month was actually pretty good. We had our initial $25,000 that we invested. We brought in $1,500 and $3,000. And our expenses were, they were $12,100 for various things, but I still have a debit balance. When you want to be concerned is when your credit amount is larger than your debit, because that means you will have a negative cash balance. And that is something you do not want to have in your business. So hopefully these transactions have provided you with a basic foundation of which to start in accounting if you've never experienced accounting before. My best advice to you again would be to memorize the normal account balance table that I have listed on the board, as well as the 4-step transaction analysis, because that really will help you think through the process of analyzing each business transaction.